Welcome back to Money Majlis. Today we are going to talk about the wealth management industry making waves both in the region and globally. In the first part of today's podcast, I'm going to share with you my views on the intergenerational wealth transfer and the demands of the new generation of millennials on the wealth management industry. In the second part of the podcast, we will discuss and debate the opportunities and challenges of the industry with two well-known industry professionals. But first, a commercial break.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by Weo Bank. Fuel your ambitions with banking designed to power your success. Discover more at weo.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aqua Now, the premier crypto-as-a-service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
The great wealth transfer has commenced. In the next 25 years, an estimated US dollar 100 trillion of wealth will change hands from the older generation to the younger generation. Let me repeat that. In the next 25 years, by 2050, an estimated $100 trillion of wealth will change hands from the older to the younger generation. Isn't that surprising? The bulk of this inheritance will go to millennials, people aged between 25 and 40 today. Millennials comprise 25% of the global population, make up the majority of today's workforce, and will reach demographic peak in 2025 on a global scale. With their combined annual income crossing US dollar 8 trillion in the United States alone, they will have a dominant influence on consumption, investment, and wealth management. Now, the concept of wealth management has been around for a long time, since the 1930s. And yet, no one generation has changed this industry's dynamics as much as the millennials. Worldwide net private wealth is estimated to be close to US dollar 500 trillion, and an increasing proportion of this wealth will be owned by adults under 40 in the coming years. Adults who are tech-savvy, inquisitive, risk-seeking, socially aware, and generally considered more independent and tolerant. Now, millennials, as we all know, grew up in the digital era, making technology an integral part of their lives and a strong influence in their decision-making. Compared to their parents, they have better financial literacy and are more sensitive towards issues pertaining to the environment, climate change, gender parity, and inclusivity. Keeping these characteristics in view, wealth managers will have to overhaul their operating models to support new product offerings, modes of engagement, and marketing channels. So new product offerings, new modes of engagement, and new marketing channels to serve this younger generation better. Now, unlike previous generations, millennials readily embrace new and innovative ways of managing finances. They actively seek information on resources to educate themselves and do not just rely on external advice. Having witnessed a plunge in property prices during the subprime mortgage crisis of 2008, they mindfully chose to keep their financial liabilities low. This gives them the bandwidth and flexibility to take higher risks and invest in various traditional and non-traditional investment avenues. So the investment habits are quite different. A recent research shows that millennials are one of the most complex, important, and demanding groups of clients for wealth managers to understand and serve. The good news for wealth managers is that millennials are more open than their parents to sharing their transactional data, their social media profiles, and even their GPS locations with providers in exchange for greater personalization. Despite their comfort with digital channels, millennials also value the ability to discuss matters with an advisor, whether virtually or in person. New themes are emerging. The sharing economy, the climate emergency, and inequalities are on the compass of the younger generation. While yield remains a cardinal point, asset allocation also depends on the values promoted by companies. Hence the rise of green finance products and sustainable investments based on extra financial criteria like ESG, which is environmental, social, and governance factors. So, what is expected then of wealth managers? First, millennials expect digitization at every touch point and demand personalized experiences. They do not prefer the one size fits all approach for their wealth management services. They would want advice in a Netflix style, data driven, and hyper personalized model. That's correct. A Netflix style, data driven, and personalized model. Second, millennials are more open to taking risks than older generations and are willing to invest in speculative assets such as cryptos, digital, and alternative assets for higher returns. A recent survey revealed 46% of millennials who are millionaires own cryptocurrencies. That's nearly half. Third, millennials prefer to be independent and self-reliant. Wealth managers have to harness technology to educate and guide their clients to make well-informed investment decisions rather than merely prescribing investment plans. And finally, millennials take an active interest in ESG issues and proactively incorporate these philosophies into their investment decisions. It is estimated that 61% of millennial investors currently participate in impact investing, and this share is likely to grow significantly in the coming years. As the great wealth transfer takes place and about US dollar 1 trillion of wealth changes hands in the Middle East by 2030, remember the figure was $100 trillion globally, and the figure for the Middle East is $1 trillion, 1% of that by 2030. So as this great wealth transfer takes place, wealth managers both regionally and globally have to prepare themselves to cater to a new and different cohort of wealthy individuals. To debate and discuss the great wealth transfer and the overall opportunities and challenges of the wealth management industry, I have with me today on Money Majlis two seasoned professionals from the industry. Maurice Gravier, representing an incumbent market leader, and Mark Chahwan, representing a nimble challenger. Maurice Gravier is Emirates NBD's Group Chief Investment Officer, overseeing investment policy, process, strategy, and security selection for the wealth management businesses of Dubai's biggest and Middle East most profitable bank. Maurice started his investment career at Natixis Asset Management in Paris before moving to Lombard Odier in Geneva. He relocated to Dubai in 2017, initially joining the executive committee of a multi-billion dollar family office before taking his current role with Emirates NBD. Maurice is a French national and earned a master's in management and business economics from ESCP Europe in 1995. A father of two, Maurice is 53, an avid reader and traveler, and spends a lot of his free time walking his dog and blaming himself for having sold his bitcoins in 2012. Sorry, Maurice. Mark Chahwan co-founded Sarwa, a leading one-stop financial technology platform for investment and personal finance in the Middle East. He is a new generation executive with 10 years of experience across diverse roles spanning strategy, management, operations, and technology. Mark has previously worked at organizations including Accenture Strategy, focusing on banking and wealth management, and with one of Canada's largest pension funds. He started his career at Blom Invest Bank. Mark studied finance and entrepreneurship, earning his Bachelor of Commerce degree from McGill University. Mark is all of 32 and was recently blessed with a baby boy, Matthew. Mark and Maurice, welcome to Money Majlis.
It's a pleasure to be here.
Thank you for having us.
Mark, we have an interesting debate ahead of us, and let me start with you. First of all, congratulations on your baby boy.
Thank you.
And on Sarwa achieving its first profit milestone, as well as crossing a cumulative trading volume of 10 billion dirhams recently. It affirms the trust and confidence that customers are placing on Sarwa as a platform, so well done. You are one of the first wealth fintechs to set up in the region way back in 2017 primarily to democratize investments and to offer an affordable, self-directed digital investing platform for the younger generation, okay, or for, let's say, digital customers. Now, we talked about the great wealth transfer earlier. Now, with this great wealth transfer in motion, and with $100 trillion of wealth expected to be inherited by millennials and Gen Zs, of which $1 trillion is just in the region, in the Middle East, you seem, as Sarwa, well positioned to capture a lot of these flows. You're a millennial yourself, Mark. What are some of the key trends you're seeing from this demographic segment of millennials and Gen Zs, and what is defining their investment choices?
Yeah, happy to cover that, especially just speaking from my own experience that led to the foundation of Sarwa for my co-founders and I.
Yeah.
In 2017, we noticed that I started to see that there was a gap in what the investment industry was maybe discussing and what we were experiencing.
Mm-hmm.
We value ownership and asset ownership differently. We've seen also the rise of Airbnb, Uber, and a lot of this speaks to our ability not to be tied too much, for example, to home ownership.
Mm-hmm.
So when we think of personal finance and investments, we're less tied to this definition of success that or this defined ladder of what it means to be wealthy or to progress. And I remember a discussion with my mom back then when she was telling me about potentially buying a house, and I was encouraging her to look more into ETFs and into fractionalized ownership without having to go through this whole what could be intimidating as a process. And a lot of these discussions led to my discussions with Jad, Nadine, my co-founders. We felt like actually quite a lot of people aren't so convinced that this is the immediate next step. There's a lot more options out there for people to park their money or to build their wealth. And we felt like that gap is something we can address as scratching our own itch and solving for ourselves, where we can get started with a few $100 to start investing rather than have to make this very big commitment across 20, 30-year mortgages, for example. And so a lot of that behavior, I think, underpins what's leading to some of the elements you've discussed, including a personalized advice. I think a cookie cutter approach where we're recommended products doesn't work for us. We want personalized portfolios, personalized advice. I think you called it Netflix style advice as well.
Correct.
That really gives off what we aspire. We use that word actually quite a bit when we're trying to innovate or talk about personalization. So another trait or trend I'm seeing is that they remain and have been underserved by the incumbents. That by one reason or another, they're increasing their minimums. They're having to cater to when they do an 80-20, it's not millennials that are going to maybe come up on top as a segment, which leaves a lot of room for challengers to come in, look after them, and they really appreciate it. You mentioned they have very high expectations, but they're also very loyal. They recognize that you were there for them and have helped them when maybe a lot of the other banks would have maybe pushed them off to retail or online, where we're rolling the red carpet for a client base that will remember that as they grow, and which feeds into the wealth transfer. I think maybe now it might be a bit late for people that have didn't look at this segment
Yep.
when others have been really focusing on that.
So what's your 80-20 then for Sarwa, Mark? Is it 80% millennials and 20% others?
That's
Is
right.
that what it would be?
Yeah, that's right. It's almost the flip side, exactly.
Maurice, do you agree with Mark's assessment that the millennials are quite different from other customers in the investment choices? Also the fact they are kind of underserved by big incumbent players like yourselves and Emirates NBD. How are you seeing the younger generation investing differently from the older generation?
Yeah, first I'm learning because I'm a Gen X myself, so so it's better to know. You're right, we're underserved to some extent. For me, the key generational change is probably about access, and it's in many fields. When I was young, if I wanted to have a phone call with my girlfriend, it was in the middle of the living room with a fixed line, you see. And just to take a parallel, suddenly this generation, they have access to all kind of products, which is fantastic, but also a bit dangerous. They also have access. They have access to all kind of knowledge. It's amazing that you can find a very credible YouTubers that explain you the limits of the modern portfolio theory or whatever. So you have all these. For me, that's the massive difference, because at the end, the objectives of investment, I don't think they are fundamentally very different. There are some risks, because if you're given access to all the products without knowing, with on top some on social media, this get rich quick scams, you also have some big risk. And what I see, you're very right. The traditional scheme of first you buy your house and then you prepare for your retirement, it's a bit different. I noticed that this clientele is also much more cost aware. I see this idea of a building future passive income, which is something that is interesting, because it's not something that is that huge for my generation or the usual clients we serve. So we have to adapt to that. And it's funny, because at the beginning of capitalism, I mean, in the 19th century, you measured the wealth of somebody by its passive income, precisely.
Correct.
Having said that, I don't think that the fundamental needs are different. Maybe we don't speak to them in the right way, and it's not a good idea, because there is this wealth transfer actually.
Yeah.
But are you, Maurice, therefore creating different products in the bank for millennials, or is it all the same for everybody?
We have, I don't want to speak too much about my bank, but we have our own online bank, which targets probably in a much more appropriate way the millennials. Having said that, the investment engine is the same when it comes to investment strategy. I mean, a good idea, a robust portfolio construction for a $1 billion portfolio is probably the same good idea for a $500 portfolio as well, and you have different tools to address it. The investment engine is the same so far. Specific products, I'm not sure. I'm a bit old school. I think that what matters is to be relevant in terms of portfolio construction and matching the objectives of the investor.
Now, talking about the industry, Maurice, after a drop of 9% approximately in 2022, global wealth management AUMs have rebounded in 23 and now in 24, especially with the equity markets, the way they are going.
Sure.
It is, as per one report, supposed to grow at 6% CAGR over the coming 5 or 6 years. What is your view of the shape of this growth? And, given that growth, how do you advise your customers to manage their asset allocations?
Oh, it's two big questions. First, I think that we are in a pivotal moment with two big facts market-wise that we can't ignore. The first one is that the monstrosity of zero or even negative interest rates is behind us, and that's the first good news. I mean, you have a benchmark, you don't have this kind of thing, and that's even a reason to have some kind of organic growth of wealth. At least nominally. The other thing is it's a two-sided phenomenon. Is that the world is not one anymore. You have on one side the old world, where how to say that? It's about the regional distribution of wealth.
Yeah.
Wealth follows economic value added, which is pretty much growth. In the West, you don't have population growth. If you want growth, it's productivity. It's a kind of a Schumpeterian growth. So it's all about innovation. And for the rest, yes, there is a wealth transfer. There are also amazing debts, public debts in particular, to funds. So you have a transfer with a tax erosion. And I mean, it's a more difficult world. And even you can question the sustainability of some debts in the West that were never questioned in the last 100 years or so. And on the other hand, you have what I think is the biggest investment opportunity. It's a secular thing. It's the revolution around the Indian Ocean, let's say. There, it's not a Schumpeterian growth where you have to innovate, to disrupt other things, to be productive. It's about just, I would say, Ricardian growth, if you like the economics, which is just optimizing the trade within an area where you have population growth and GDP per capita improvement. And I think that wealth will grow much faster in this part of the world. And when it comes to asset allocation, it means that you have to be careful. In the West, it's all about, for me, innovation, the disruptors, and not that much about just funding these governments that have lots of debt. And in this Indian Ocean, South, BRICS plus, whatever you call it, I think you will have much more balanced returns from bonds, from currencies that are going to be stronger, and from all segments of the economy. So I think it's something to keep in mind for the long term.
Oh, that's good. That's good. Mark, Sarwa is based in the UAE, and the UAE has been one of the best performing markets globally. It's also seen very impressive cross-border flows, gaining, very, very high popularity as a booking center. In fact, last year was the fastest growth as a booking center globally for UAE. It is estimated to become the sixth largest booking center by 2028. Now, since you are based in Dubai, in the UAE, can you explain some of the drivers of this growth that we're seeing in the region? And how are you as a wealth manager looking to capitalize on this?
Yeah, I think the growth, there are maybe better people to comment on the why, but one thing I've seen UAE do really well is just the leadership, especially in a time that Maurice is describing, is quite difficult, I imagine, as a country and economies to navigate. I think they've been doing a fantastic job to navigate that. So
especially post-COVID.
Exactly.
What we've seen the government doing here is absolutely amazing.
Yeah, we've had very different COVID period than some of our some other people, and so I think if we just take out how they've managed crises, I think is very remarkable, and it has set them ahead. I think what it means to wealth platforms and managers, I want to say that I still feel like we're very early days. When I look at the US, for example, I look at a number where stock ownership reached are already more than 50 to 60%. It's tough to get that data here. Maybe Maurice, you would have it, but I think I would guess it's very, very far from that. So I think recognizing that the opportunity of being a leading brand or an emerging brand that is focused on this industry, doing a lot of financial literacy, like we were talking about. People are much more curious today, and especially since COVID, around personal finance. So there's an opportunity for brands to build their name for the long term, to capitalize on the interest in investing, and to recognize that there are a lot of people that are going online and are investing for the first time. So it's not just about the competing and targeting the same people that have been investing and maybe moving money around. It's more about why are people going to choose you specifically? And that's a very personalized answer. For us, it meant, let's keep it simple. Simplicity above everything. And that's still our core anchor. So there are many other opportunities, including now we're seeing a reconvergence of a rebundling of products. I think initially when fintech started, it was very much around doing one thing really well and specializing. Today, we're seeing people, once they trust you with one product, they're okay to, and they're excited to try other verticals, other products, whether it's savings to investing to short-term trading. So I think that's another opportunity where it seems to be a balance that changes every couple of years.
So are you expanding your product range at Sarwa as well as a result of that?
I would say we're a product-led company, and that's the main way we've been growing, is constantly adding innovations and asking customers what they want to do that. And we evolve as well. I think when I started, you could find an interview of me saying, "Don't trade, 100% passive. Why trade when it's so difficult to beat the market?" Then as I evolve and the team, we're starting to see, well, actually, as long as you set parameters, I get why. I think you work within the parameters of placing a few certain bets emerging technologies, maybe we'll discuss crypto as well, are coming up. How do you approach that? So I think it's important for firms as well to constantly redefine themselves.
So what percent of your customers are active traders, you think? Roughly? Less than half?
It's such a subjective metric on active traders, but I would say less than half, yes.
Less than half?
Oh, but growing. I think I like to see, I started to see it more as self-directed. There's different ways of looking at it. Is it self-directed versus managed portfolios? And I think that's a more accurate way of looking at it. Because we see people that are self-directed, but they're not traders. They're buy and hold, or they're value investors. We see the specialized traders as well that focus on one specific strategy. We see the explorative trader that just wants insights and expects the platform to provide that as well. So, but one thing's for sure is that people change throughout. What starts as a value investor starts to add certain aspects. So we're seeing that it's not a one size fits all, as you mentioned as well in your article.
Yeah.
It's a bit more dynamic and personalized than that.
Got it. Maurice, the last Henley report on migration talked about 6,500 millennials net moving into the UAE, higher than any other country, higher than Australia, US, etc. Now, I know you've been on the UAE Banking Federation committee looking at how to make UAE a wealth management center for the future. What do you think needs to be done still to make the UAE a shining beacon for wealth management?
The potential is immense. I will start with that because I will start with what we have. And as you are very rightly saying, we have an amazing leadership, and the COVID is an example. But even the neutrality of the country. I was in Switzerland before moving here, and I'm absolutely convinced that the UAE is the next Switzerland, and the world needs a Switzerland. You know, Europe has London and Geneva, let's say.
The weather is a bit different, but otherwise it could be
the weather is
right?
different. But look, I love this parallel. But Switzerland has built his wealth management business with let's say 700 years of being neutral with very turbulent neighbors that were all at war together. So you see the kind of parallel that I'm making. And
that's true.
Switzerland is not that neutral anymore, and there are lots of debates because they were during World War II. They were not during they are not anymore during the current conflict. And the UAE is very smart. So there is this kind of a top-down thing that is here, and then there is the money, as you rightly say. People are coming, but even 2/3 of domestic wealth is managed offshore. And I'm not just talking about the ultra high net worth, super sophisticated family offices. I'm talking about the people who work, who save money, they invest elsewhere. So we have all this. What do we need? For me, it's a business where there's little barrier to entry. Actually, we are blessed. The big banks, access to clients is a barrier to. It's a competitive advantage, and we have that. But the rest, it's about having the best people. It's about, for me, the quality of the advice, of the strategy, of the service, and the best people need scale because it's a scale business. When you go from 1 billion to 10 billion, you don't have to hire 10 CIOs.
Correct.
Well, maybe you can. You can pay it a bit more, but and it's all about this virtuous cycle. We need to upskill the place, and I'm a bit sad to say that, but frankly, there are wonderful people. There are also people who are not at the level. Sometimes we have to work on cultural changes. That's what we're trying to do, and especially, again, I'm a bit old school, but from the short-term trading, sometime to more portfolio construction and this kind of thing, we are progressing, and we need to work a bit on the ecosystem as well, which includes the regulation, because some element of the regulation with the best intention, sometimes it's a bit the best intention of protection or whatever. Sometimes it's a bit harsh, but we're working on that, and the UAE authorities are really pushing because they know. I mean, financial services are our priority. Yeah.
Excellent. Mark, you talked earlier about trading. Now we've seen a number of trading platforms launching in the region, right, or in the UAE specifically, Interactive Brokers, Saxo, eToro, etc. And of course, the big banks like Emirates MBD are launching their own trading platforms. You can trade on Emirates MBD's app. You can trade on the Vio app and a Mashreq app. Quite a few banks have now launched their own full-service wealth management apps. You offer trading as well, as you said, in Sarwa. What is a good mix, you think, for retail customers to follow in terms of the split between long-term investing and short-term trading?
I think typically we'll say 80-20, 90-10. And I've been trying to understand recently, we look at a lot about at the difference between our AUM to net deposits to see if that's healthy, and I've been scratching my head because we've seen that it's been very healthy on the self-directed side. Something that if you read your typical newspaper, they'll say, retail traders lose money, underperform.
Correct.
And I haven't seen that. And I'm very happy that we haven't seen that. And today I had a meeting earlier actually with more of a traditional brokerage house, and I'm starting to understand why. And I think a big part of it is due to leverage. We don't offer leverage today, and if we do, I think it would be tiny compared to what's available out there. So I think the term trading could have had a bad rep, mainly from some of the behavior and what's being made available to retail investors, where they can magnify their losses and get hurt. But otherwise, I think, imagine how powerful Maurice's sentence earlier, that people know the limits of modern portfolio theory. I would have never thought that there would be content. I would have thought it was too boring for it to go mainstream. But we're seeing so much great content. To understand the limits of modern portfolio theory is quite impressive, I would say, on where we're getting in the financial literacy. So I think there's a lot more, and I think the self-directed folks can outperform the managed service, or it can stand its weight because of the main advantage they have, which is agency. They are managing their own money.
Correct.
They will behave and be much more, they'll manage risk in a very superior way than managing someone else's money. So of course there's pros and cons. For some people there's we're still predominantly until today more of a managed service. We have both verticals, and I like both. I think it's important to have both and offer that. But the behavior and the branding of the dumb money that retail investors can have has been quite strong actually, and I think in big part due to their own financial literacy that has been really stepping up in the last few years.
Excellent. Maurice, a slightly broader question for you. We've seen global wealth growing quite consistently in the new millennium, except for maybe a few crisis years. But inequality of wealth distribution continues to be a problem globally. About 1% of the adult population, 1% only of the adult population holds close to half of all wealth. And the bottom 40% of the population holds only 0.5% of total wealth. Also, average wealth and median wealth is hugely different. In the US, it's 5x, the average wealth to median wealth, which highlights concentration, obviously. Money begets money, as I say, right? Now, my question to you is, how can the industry help the less affluent also grow their savings and wealth in line with the overall? Will we see a trend where the less advantaged also get access to wealth management tools, be able to manage their future wealth?
That's a big question, and I will start with a kind of a philosophical statement to start with. Some level of inequality is not only inevitable, but I think it's positive, because I think that we create wealth with in capitalism, with taking risk, and you need to get a reward. Mark, you're an entrepreneur, you take risk, you need a reward. So there is a level of inequality. I'm no communist at all to start with this statement. Now you're right. It's a big point, and sometimes agendas of different, even different parts of the same bank, for example, can be a bit conflictual. Because before, you have to go from saving to investment, but before that you need to go from spending to saving, and that's the first thing. And it's about budgeting, it's about discipline, and it's not something easy. It's about literacy, and in some places, I mean, in Dubai, we all know the temptations of the lifestyle, and that's really the first thing. Then, of course, we can help. And as you were saying, the democratization of the access to the products is absolutely huge. And people always often look for solution from the political world, and especially in the West. And I think that it's a wrong way. Again, I'm not communist at all, but you can't just borrow money on international markets and give it to people that will at the end spend it, because this money will not be saved. And I think it's about, there are painful adjustments, it's about discipline, and then it's about value creation. And now there is maybe a big threat for the future, a big question mark, because with artificial intelligence, some people say that unemployment rates could go through the roof, and there is in particular this Davos favorite, Mr. Harari, who says, "Oh, there will be the emergence of a useless class," and he said in an interview, "We'll have to keep them quiet with video games and drugs." And I don't think that that's the fate I want for humanity. So let's all try to be like Mark and be entrepreneur. And for the rest, then from savings to investment, I think that it's our job, and we know how to do that. It's about having an investment horizon, risk tolerance, the right tool. So it's not easy. It's part of the solution, but it's not the core of the solution. The core of the solution is to work hard and to be disciplined.
Thank you for that. Maurice, staying with you, we are seeing a drop in margins, right, in the industry. That's across the board. Advisory fees are dropping because of competition. There's disintermediation on broking and trading fees. Rates are now trying to drop, so that will also mean pressure on banks' incomes. There are rising technology costs, rising compliance costs, which has hugely gone up in the last, let's say, decade or so. What are some of the strategies that wealth managers like yourselves are adopting to counter this?
Well, again, first, another statement. I think it's a very positive thing. And competition makes us better, and the compression of fees is a natural thing. We've seen it, I don't know, in telecoms. You remember the kind of invoices you had 20 years ago?
Correct.
The industry didn't die. It's just that the bad players were out of the market, and I think that's what's going to happen. And the answer is probably about, of course, you have IT solution. You can always be more efficient, but at the end, I think it's a business of scale, and the scale in a business where barriers to entry again are quite low, scale will come to the best, as simple as that. And I think it's a positive thing that is happening, because pricing has been too high a bit everywhere. I'm not talking specifically about here. I was in Switzerland when the bank secrecy was here. Margins in Switzerland were a bit outrageous, and now UBS has something like 80 basis points of average margin on their $3 trillion of assets, and I think it's only reasonable. And again, it's a good thing.
Mark, are you seeing your margins dropping as well since you started your company?
No, actually, we've gone the other way.
Really?
I think fintech has overreacted when it started into wanting to undercut pricing, and now
you went too low, you mean?
Yeah, many players went way too low.
Yeah.
And I think with those that have, to Maurice's point, survived, done well, evolved, have found a better balance, and I think for us, what's really important. You mentioned the likes of some big brokerages. Why do customers choose us ultimately is much more on the value than just the cost basis on its own. Why compete with someone that has the scale based on price? It's not necessarily the best thing to go after. So, but on value, on customer service, on the type of interaction you have, having, whether it's the quality of the advice, the speed of the interaction, the speed of funding your account, speed of just getting things done on a micro interaction.
Yeah.
All of that, then people will start to say, you know what, I do want to deal with a local provider. I have this person there that I trust, and the innovation I'm getting is very tailored to me rather than it's an imported solution that has worked well for the West or for certain countries. So yeah, I think it's super interesting what's happening. I would add transparency. That is, I still think we have a long way to go. Maurice was touching on regulation that can be beneficial.
Yeah.
I think that area still needs a lot of changes. That is actually 100% customer protection, and because it will ultimately give customers clarity over the fees they're paying. I still feel like it's too easy for some firms to not to fully disclose what they're really charging.
And are you doing a lot of work on financial education and empowerment for your customers?
A lot. Ever since we started, we would do like pizza nights, where whether it's 5 people or 50 that show up, we would go over the 4 rules of investing, the mistakes of investing. Almost every week we have a webinar We love to cover also stories. I think people relate more to.
Yep. Yep.
There's one teacher we really like to collaborate with that's retired at 38 on a teacher's salary by being frugal and investing very early.
Wow.
So we like to highlight these stories where, especially in Dubai, where sometimes you can have an illusion and the cost of life can be discouraging, but also if you navigate that properly in a tax-free way, the opportunity is quite massive to take advantage of this. So a lot of financial literacy. Now we're starting to get into more complex product. Like we launched options recently, which we're like, oof, okay, this is we're gonna need to simplify this quite a lot.
Yeah.
And it's a fun challenge. We love doing it in person and on webinars. I think this podcast is a great initiative for us as well.
Yeah.
Long form content. So we got it in many directions.
Let's talk then. A good segue into the most exciting asset class for a lot of people today is the crypto. Right? I mean, I read a report that global AUMs in crypto have just crossed $100 billion. Yeah. And, especially with the BlackRock's ETF, IBIT, it's kind of taken off in a very significant way. Now, traditional markets are uncorrelated with crypto, so is the belief. And a lot of people want to diversify their holdings with a bit of investment in crypto. What is your take on this space, Mark, especially as a millennial? And as a founder of a platform like Sarwa, how do you see adoption growing in this? And what advice would you have for investors who are entering crypto for the first time?
Yeah, it's definitely an exciting one for many, and I think we probably all have that one crypto friend that is just once someone is into crypto, it becomes a core part of their their selling. They become really passionate about it because. And the reason I think that happens is it's much more than money for a lot of people. It's a way that's the way it's grown up. It's much more decentralized. It's much more bottom up rather than it has a technology angle to it. I recently did a webinar with BlackRock that nailed a trend that I'd like to share, which is it touches upon the distrust of government as well. Maybe not so applicable here in the UAE, but I think in other parts where the government is failing some people, or that's how they feel when it comes to some of the issues around inflation, and they start to look for other answers, and the level of debt that we're discussing. So for a lot of people, putting all of that together, for right or wrong, the answer will be, for example, Bitcoin. Others will say, well, no, not just because all of these things that are wrong and maybe and problematic are true, but doesn't necessarily lead to that as the same conclusion. So all this to say, I would say, get behind the why, behind and there's no shortage of content around what is exciting about the underlying technology and use case, so that you avoid buying based on FOMO or selling based on fear. That's a very painful experience that I don't want to remind Maurice of, but for sure, I think maybe that can help, but there are ETFs as well available, so that you're not stuck between. I think one framework we've introduced to our customers is with a toggle to be able to buy an ETF and allocate up to 5%, and I think that removes a lot of this inertia. Where you're not in it, you're out. It won't make or break your retirement.
Correct.
But it will protect you from yourself, so that you don't over allocate to it as well.
Now, Maurice, as someone who sold all his bitcoins in 2012,
Okay, you did it, not me.
What advice do you give your investors today in 2024, 2025? Do you advise crypto as a separate asset class for customers? Do you think an average investor should hold X% of crypto, 1, 2, 3, 5, whatever percent do you think? Is that what was said about gold 10 years back? Is that what you should say about crypto today?
The parallel is interesting. There are crypto, and I will start by my own story with Bitcoin. Is that I was very early. I was playing with it. I was seeing that as a currency, as a mean of payment. So I sold it because I had finished playing with that. I regret, but that's how it is. So now, first, I agree with you. The blockchain technology is fabulous. It's fabulous. The use cases are multiple in multiple ways, and especially for wealth management. And personally, I'm very excited by the the transparency, the traceability, the fact that you have trust, which is not in a person or in a corporation, it's just in the chain. Having said that, most of the applications I see, for me, are totally immature. And I say most, there are exceptions. And Bitcoin, we work on Bitcoin for long, from a quantitative point of view, and I would respectfully disagree with the idea that it's totally uncorrelated. So far for us, it's pretty much equity risk appetite on steroids, with a few other factors, but it's not really diversifying per se. Having said that, the idea of protecting oneself from currency debasement, I think it's a very credible digital gold. It's just too volatile now, maybe because gold does the job. If you don't trust, I don't know, if you are in another government and you don't trust it, you don't trust the currency, gold, or I don't know, Swiss franc or this kind of thing, they can still do the job. But I see Bitcoin as a credible alternative to that, as a digital gold, more convenient. The Bitcoin market cap is around 1.3 trillion, gold is 20. I'm not saying that Bitcoin, to match it, you put Bitcoin at 1 million. Having said that, gold is also a reserve currency for central banks. It's also used in jewelry. So I don't know. I can make a case for the Bitcoin at $200,000, but when volatility becomes much lower, and so it's always the same, and you know that there is a world between a personal opinion and a personal work and a professional advice when you have the fiduciary responsibility and when you're talking about other people's money. So I have immense sympathy for Bitcoin. For a few other level one, which I see as a kind of a ownership of a network with you stake it, you can have some return, and it makes sense. It can be modeled, but we didn't reach a conclusion yet. And for the time being, too much volatility and too much, frankly, too much scams in the NFT, in the meme coins, in this kind of thing. You just too much noise. But we are working on it.
But you don't ask my question. If I had to invest my wealth in a variety of asset classes, would you recommend I put a certain percent in Bitcoin?
Currently, I would recommend that you put between 5 and 10% of your assets in gold, precisely for this idea of currency debasement and one day part of it in Bitcoin. Currently, we do not put it in our asset allocation, but we work on it.
Okay.
From our simulation, we found an optimal weight, which was half of what we put in gold, and we're working on the combination. But we want to be sure. Which is funny because in what we do, you're never sure. You work with probability, but we want to have a level of we have a framework. You can't just say I'm bullish, and there are so many people who do technical analysis or kind of poor research, but who can be very convincing, and they do videos with their Lamborghinis and everything.
You're not convinced yet, is what you're saying.
Oh, I'm convinced by blockchain. I have I think that Bitcoin is credible as a store of value. Currently, I cannot put a weight in as a professional advice.
Fair enough.
But we're getting there.
Fair enough. So, Maurice, staying with you, let's move to another hot topic, which is sustainability.
Yes.
There's obviously a growing participation influence of millennials and Gen Zs who want to put their money where their mouth is, which is ESG, and sustainable investing is now becoming, a norm, a fashion, and I last saw a report which is 7% of AUMs globally in funds. 7% of fund AUMs are now in funds that call themselves sustainable. But what is interesting is that these funds generated an impressive median return of 12%, higher than the 9% median of traditional funds. Now that gets my interest in a significant way because it's now suddenly becoming interesting from not just an ESG perspective, but from a return on investment perspective. What is your view on sustainable funds, Maurice? And do you think this trend will continue? Is my first question. And second question is, what about greenwashing and how do investors protect themselves against it?
Yeah. I will start again with a philosophical statement, if you don't mind.
Sure.
Investments are all project themselves in a future world. It's all about transporting capital over time. So there's no doubt I believe in sustainable capitalism to that extent. Your money, you want to get it in a future world. You don't want your money to harm this future world. And that's first how I see that. I believe in sustainable capitalism, really, which is taking care of the stakeholders and whatever. Now, to what the assets and wealth management, mostly the asset management industry does with that, there is the best and the worst. And the proportion is probably probably 80% worse, in my humble opinion.
Really?
Yeah, it is. Unfortunately, the best asset manager I know are sustainable by nature, by design from the very beginning. One company that is very famous, but I've also seen many mediocre asset managers that reacted to the margin pressure that you mentioned earlier by saying, okay, so we are not great, we are mediocre. Now we'll use ESG data and we'll continue to charge. We'll remove our tie and we'll say that we are green. And it's a maturity, frankly. And I believe in this Schumpeterian dynamics that these people should at some point be out of the market. I have forgotten your very question, but
no, my question was: do you think this green investing or sustainable investment will continue as a trend in the future?
I believe in the fact that you have to take that into account in your investment. But for me, running a portfolio. It's like an electric car. First, it has to be a good car, electric or not, and then people will be happy to have an electric car. For me, if you run a portfolio, it first has to be a good portfolio. And yes, of course, it cannot harm the future, as I was saying. So we exclude the worst offenders. There are things that you even don't touch and you take care. But just making a mediocre portfolio and saying that it is ESG, it's unfortunately
but the returns seem to be better, no? 12% compared to 9%? Is that something you believe, the number?
I've seen many, in my previous life as a portfolio manager, I started to run what became one of the first ESG labeled fund in Europe. And the reason was we highlighted governance, good governance, taking care of the shareholders, of all the stakeholders.
Right.
And we did that not because it was trendy, because it was material. It was not material on performance, on return. It was material on risk. And it was post Enron, 2003. You were born, yeah, probably. And it was because it was material, and I believe in that kind of approach, because if you want to really, for me, investment should not harm, but they should deliver well in terms of risk-adjusted return. If you want to do things for the planet, for the communities or whatever, the best way, frankly, you have a good portfolios and you do direct impact investing, you do philanthropy, you do private equity in this kind of field. Here you have much more impact than saying, oh, the average ESG rating of my portfolio is 3.2 while the benchmark is 2. That doesn't make lots of sense. Having said that, we exclude some things from our list. We look at the ratings, and yes, of course, we look at the mega trends of the, let's say, the transition of the economy. Yes, it is, as a pool of alpha, it is interesting.
So you're saying we should all have a healthy skepticism of what we see in the industry being called as
always, I haven't seen this precise research, but maybe if you just have a higher mix of equity funds versus fixed income, when in 2022 the fixed income had one of
the returns are obviously going to be different.
You can have this kind of bias, because for me it's not obvious that there is some alpha, even if, again, the best asset manager I know is sustainable from the beginning.
Understood.
I also, just to add to that, I really relate to what Maurice is describing, where the biggest impact can be more direct rather than through, as much as I love ETFs, I think this is an area where you're talking about thousands of companies in one ETF. And we've seen cases where we present an SRI, social responsible investing portfolio, to a client. They, well, that company, I heard something about it last year. And now we've seen ultra SRI portfolios develop from that scrutiny, where customers keep calling out certain companies or want to filter more and more. That it's just more effective, I believe, if you also are more involved in your local community and have a more direct impact than relying on or purely relying on portfolio constructions to do that. Well said.
Now, Mark, staying with you, let's talk about another favorite topic, I'm sure, of yours and all millennials, is Gen AI. Now, generative AI will add $4 trillion to the world's GDP, says a report. Just on banking alone, the expectation is $340 billion annually is the impact to banking revenues. That's a McKinsey report. Now tell me, how do you think Gen AI will affect the wealth management industry? Do you believe digital assistants will come to help customers choose the funds? You talked about self-directed investing earlier. In your view, how will a platform like Sarwa take advantage of Gen AI? Or are you doing that already?
Yeah, it's a theme that's been kind of there in the background, but now definitely front and center. When we started, people called us a robo-advisor. When we were just a tech-enabled investment platform, wealth manager, I didn't like that term a lot, but I remember when there was in the newspaper, they'd pick like a robot and things like that.
Yeah.
And it still bothers me. But it played out where clients it didn't really cater or attract, it didn't really play out where someone wants a robo to, there was a few stories about a robo managing your money and things like that. It didn't really catch on. I personally didn't think it would. I think it won't necessarily. I think people...
Is that term banished now, robo-advisory?
It's not, but it's kind of played out where you see it, you won't necessarily... It won't be a threat. If I'm a banker, if I'm whether an incumbent or a challenger, I look at it and I don't feel a threat.
Okay.
Because I know that a great experience is a mix of human interactions and technology.
Correct.
So I think the Gen AI topic can sometimes be can provide a certain more clickbait version of it that clients aren't even asking for. What they are asking for is just a ton of speed, especially around low value or transactional elements.
Correct.
And I think the infrastructure could still use a whole lot of that. So I cannot wait for the type of account opening, account funding, portfolio monitoring, and everything that's going to bring there in terms of a speed of executing transactions and insights. I think it's phenomenal. I think the distinction we're making, we have our own bot, by the way, that's already live, but there's a certain reluctance on the team where on one hand we like that responding in seconds, getting things done in seconds. On the other hand, it's almost the opposite, where like Blumbank, for example, in Lebanon, you call, and my mom is one of the ones that pioneered it. You call and you have someone say, "Hello, how are you?" Imagine that. You call your bank and someone just said, "Hi, how are you? How can I help you?" Like, it's just also such a weight lifted from still having that human interaction available.
Yeah.
So I think it's balancing business needs of automation and cost with how much clients still want to talk to someone. Our main issue actually is how can we reach out to more people? How can we connect with more people? It's not how do we increase our minimum to talk to less people. It's still very much, as I said earlier, we're in very early days of stock ownership, financial literacy. If we were in the US at 50, 60, 70% ownership, fine. Let's talk about AI and automating so much of that. We're still at a stage where it needs to go through that education process and trust process where it's very human-led.
Very interesting. Maurice, what's your take on this? Especially turning the question around on AI still, my question to you is, how will AI change jobs in wealth management, do you think, in terms of future job definitions? And, I recently met a research company from India, which has got a full AI platform to evaluate every single stock in every single stock market in the world, every single one. 100% coverage because AI doing it, and every hour they produce a recommendation of buy, sell, strong buy, strong sell, neutral. Now imagine that, right? In a world like that, who needs a CIO?
I'm happy that you start with that because there are two questions: generative AI and AI to take investment decisions.
Correct.
And I'm sorry again, no offense, but AI is still not able to take investment decision. If it was, hedge funds would do it, and they work on it forever. In my business school in 1993, I was working on a neural network. It was path optimization with the idea of then do stock picking. I'm not saying that it didn't work, and I'm not saying that it didn't work then, it doesn't work now. But hedge funds have invested billions in that, and it still doesn't work. You can create some buzz, you can create perfect reports, you can generate some trades with this kind of things. We are not there. One day we may be, but it's not about generative AI. Generative AI is about statistics. You take a lot of information, you vectorize them, and then at the end you are fantastic for reading and writing, let's say, pretty much, or creating images or this kind of thing. And this is very useful for us, by the way, because personally, and most of the people in my team, we read. It's part of our job. We read 2 or 3 hours per day, just reading. Research, industry reports, company reports, whatever. And it's fabulous to have generative AI reading much quicker and say, hey, this looks interesting to you. And that's something we work on. When it comes to writing, we also write. And as I'm sure you know, in our team, we have maybe 10 nationalities out of 20 people. Our levels of English are variable, including myself, mine, which is quite ugly. And so I use generative AI to refine my English, and it's perfect.
Okay.
I will not take any investment decision based on AI. Well, one day maybe, and it will be either this general AI that we all fear that will change the entire world, or maybe a narrow AI system dedicated to
purely to wealth management.
To investment decisions.
But we're not there yet. You don't think we are there yet?
Sorry?
You don't think we are there yet?
We are not there yet. Having said that, we're already at a stage where generative AI makes us much more efficient. We are in this age, I think. It's first an age of efficiency. And the CIA office of UBS, there are, I think, 600 people. A big part of them is doing slides and reading stuff, and I don't think they need to be 600 anymore. We are like 20. We can still survive a bit, but for me it's about efficiency, and it will change. And I'm very excited by the interaction with the customer. By the way, it just has to be very clear that you're talking to a bot, and the system has to be, the language model has to be trained and focused on what you write. I believe in that because typically. In my team, we may have many calls from investment advisors asking for something that we may have written already in a report 2 months earlier. And if you have a system that reads that understands that, we tested that. I won't say the name, but we with one startup, I was very impressed. They just made their system read our research for 1 year, and you could ask an open question. What do you think about gold? And it would tell us the role of gold in a portfolio, our current fair value, and the last time we went overweight. That just out of the...
That is useful.
That is useful. And for AI in general, we'll see many transformation, but not replacing a CIO or an analyst yet. Making an analyst super efficient, yes.
Yeah. Distilling information is super helpful as well. Like, with everything that's been going on in the last few years, I felt like we are bombarded with information. That it's nice to have a tool to summarize and like combat a bit that trend where you just, I use it, I would say 50% I work 50, but just personal. Instead of Google, I'm turning to it a lot more, where instead of 3 to 4 Google searches, you have more of a conversational way of getting to your answer, whether it's your own content in Maurice's case or external content.
Really wonder one thing, with AI tools available to both the bank or the wealth provider, the wealth manager and the customer equally, the entire asymmetry of information analysis will go away in the future, right? You, Maurice, will know as much or as little as I do as a customer, right? And at that stage, how will a wealth manager add value to a customer from a pure advisory perspective?
For me, I still believe that managing money is a difficult thing to do. It's half an art with scientific tools that you have a hit ratio of on your decision. On 1 week it's 50%, on 2-3 years it's 60% right, 40% wrong. It's not better, but all the science is the risk management that is around, and a bit of practice and experience, because it's not just about data. The statistician used to say all models are false, some are useful. I tend to believe in that. And you're right, there's no information asymmetry anymore for some time already, because just on Yahoo Finance, I know Yahoo sounds like an old thing, but you pretty much have all the information that you have on Bloomberg. Frankly, you're not far already. And it's about being professional in something, in the same way that you have a health issue, you can Google it, you can have lots of information, almost like a doctor, but still you go to the doctor. Maybe it's a kind I'm reassuring myself, but I believe you still need that.
Yeah, because if we think about it, the very same, like the question around the individual versus hiring someone, that's trend's already been there. That's the whole concept of passive investing, right? I invest in an index fund that will beat 90% of wealth managers.
Correct.
So I already have that available. I don't need AI to get me into the top 10 percentile, right? I think here it's going to bring something more to that. Maybe it's the quality of the questions that there's now prompt engineers, and sometimes unlocking that question yourself could be the added value. But I feel like the way I see investing works, let's say if we look at venture capital, it's still quite far from that. It's very much still very relationship based, about access to a certain deal. You can have the best AI in the world, but the access to a certain class of or a certain network, basically. That this is the main value of venture capitalists and their alpha that they're generating, is their brand, is their network, and that's not necessarily, that's still secluded. where you can see it.
Replicable, yeah.
And
Fair
I-
enough, yeah.
You allow me to add something?
Yeah,
just,
sure.
just very simply, for generative AI, it's brilliant. It's fabulous technology, but it's about correlation, not about causality. You know, it's not about the why. And again, when you have a fiduciary responsibility, when you're wrong, you have to explain why and how. And we've all been through this logical loop with ChatGPT. You ask, if you ask him what is 1 + 1, he will not say 2 because he calculates it. He will say 2 because he needs relevant data sets. It's associated, it's correlated with 2. Doesn't care. And sometimes the system will make mistakes, and I wouldn't let this kind of correlation-based system take decisions.
Fair enough.
Skin
Fair
in
enough.
the game, having someone also. There's this concept still as a theme of ownership, skin in the game, and ensuring that, you know, if you're losing, someone else is held accountable.
Yeah, you're accountable, exactly.
Or is also losing and has enough skin in the game as well. Whether it's the entrepreneur you're investing in, or
Correct.
There's a certain alignment that comes from that that's very valuable.
Fair. Now, Mark, you represent a challenger, a fintech challenger in this industry, and Maurice, you represent an incumbent bank, right? Now, one would think that you have complementary skills. The challenger is faster in innovation, is obviously, you know, nimbler in decision making, and the incumbent has got the customer trust, has the customer base, has history behind it, and some expertise that the challenger might not have. You would imagine that in a world like that, a fintech and a bank, incumbent bank, would have far more collaboration than we today see in the industry. Why is that the case? Why aren't banks and fintechs working closer with each other? Let me have your view, Mark.
No, I
first.
blame the banks. I want to.
You blame the banks, of course. You blame the banks. Yes.
We see where you're going.
No, I'm joking. Just to add, to spice it up, but it's tough to pinpoint. I'd love to hear from Maurice, honestly, the answer. On our end, if I drill it down on the reason, I am as disappointed as you in the lack of partnership collaboration compared to when we started. I would have expected a lot more.
Yeah.
There's a few reasons. I think both are sprinting. Like both are very busy sprinting, have their own deliverables, whether it's quarterly, yearly, what they're trying to accomplish. That it can be it's more comfortable, call it, to focus on what you control, and rather than these big partnerships that can't pan out. So I think there's a certain element of just the busyness of and having a lot to work on and improve on each standalone basis, for sure. On the startup side, I think constraint is embraced as a good thing. So at least in this part of the world, maybe less in the US, where there's abundant funding and capital. But here you're really constantly drilling into your best ideas that you have a very good chance and or you believe that are going to pay off in a year or two.
So it keeps you sharp.
It keeps you sharp and more short term, focused on projects that are more of a sure bet and short term. So I think and then maybe these 2 points are related around short termism. That unfortunately what takes a backseat is more strategic, bolder, medium to long term bets, which exactly what these partnerships are. And that can span kind of maybe for an executive that has a 2 to 3 year outlook, this isn't what's going to be what they're going to be known for and what's going to differentiate them. So it takes someone with more of a medium term view. And the good news, I think, in UAE is that is happening. I expected more maybe turnover at the top, but it's been quite stable, and more people are staying. So maybe there is a shift that's going to happen where people start to
think
plan more further out. And I think that comfort from seeing that behavior, because you could kind of sniff it as a startup. You could see that for us this could be half or third or 20% of our team size, and you can see that for the bank this is a couple of meetings I'm putting, and I don't need to devote as many resources for it. So I think that mismatch in resources and maybe time frame of needing results could be what's causing that.
Maurice, from your perspective?
That's a big question. I agree. In an ideal world, well, first again, in a Schumpeterian way, competition is good. I mean, competition is good, and your very existence, I mean, and your success shows that we don't do everything perfectly. So, should we work together? I think that it's also a bit natural in this competitive world that when you have a big competitive advantage, which is access to clients, you want to monetize it the maximum. And we want to be as big as possible in the value chain. Having said that, we don't cover all the clients in the right way. There's no doubt. And there are probably synergies. And by the way, our bank happens to have a corporate VC fund now, which precisely invests in fintech, where we see synergies. And then what you say is very right. We are all racing, and we all have short-term pressure, which can be more or less existential. It could be about the bonus or the pressure from the management, or the valuation of the company for the next round. And I think it has a role to play. But for sure, there are many things that we could do together. And the spirit is probably different. I mean, we could try to and Suvo, as an executive in the bank, was brilliant at creating a startup internally, because it's a different spirit. It cannot be just a team. You know, we could try to we can call headhunters and try to poach you and a couple of your guys, but the day you will work in a large bank, maybe the thinking process will be different. So I don't know if there is if you can really marry both, because the bank will say, oh yeah, we will buy you and you become part of our team, and maybe it kills the thing. I don't know. It's not obvious. We're complementary. We're competitors, but yeah.
I would also add, there's still a decent amount of collaboration. It's just that we're all in this discussion. We're also for sure striving for more. Yeah. For example, ENBD, our client money account is run currently on ENBD, and that, just witnessing the growth where they've seen us go from, a couple of dollars a month to millions and millions, and dozens of millions coming. Like they've had to also, they've changed their team, their support for us. I want to give a credit to Fayaz, Amanda, Deepak, like people that are like individuals that lobby internally to Anthony. Like there's so many people
to give you support.
I should probably stop, but not to forget anyone. But there's still also a lot of them power fintech. Sometimes fintech sits on, initially when fintech started, it sits on top of banking, and then more and more kind of start to own their value chain. Yeah. But when something's running very smoothly, like the client money account, that gives us comfort to focus on other challenges. But yeah, I think there's still room for more. Yeah. But there's still some successes already, including between NBD and Sarwa.
Yeah, and the corporate venture capital funds that some banks are setting up, some banks have set up, like Emirates MBD, should definitely lead to more collaboration between banks and fintechs, right? Before we end, I have to ask you my last question. What are your top 3 tips for our listeners on how to manage their money for 2025? What should they be doing, and what should they be watching out for? Mark, you go first.
Yeah, I'll start. The first thing that maybe I sometimes like to flip it.
Yep.
Sometimes it's easier to know what not to do. So I would say don't sit on the sidelines. We've seen a lot of people struggle, especially in our segment, with inertia and almost waiting for everything to clear out before starting to invest. And we've seen constantly in the last 6 or so years, people regret holding off or waiting. So putting time on your side, and that compounding factor is so powerful, and there's no shortage of I would say content, tools, people to talk to start in your own way. So don't sit on cash and wait on the sideline. The second one I would say is don't be surprised. They're related, but don't be surprised by whatever can happen in the year. And there are ways to really be prepared. Whether it's been 2 good years, whether the third year, whether the streak continues or not, I think be ready emotionally to what's going to happen, so that you already decide if this happens, how you will behave. So that you are not either under or over invested. And I would say the third one is back to basics, and we discussed modern portfolio theory, but to diversify accurately. Although it's mainstream and it's maybe an overused word, I do think it's good to be more informed when we're diversifying. especially after a year like 2022, where equities and bonds, for example, went down in the same direction. And I think that really surprised a lot of people. Like the whole purpose of bonds is to, protect you from these swings. So diversification goes beyond the 60-40 portfolio or all of that. So be very diversified and understand, to the point earlier, what are the limits of modern portfolio theory? What are asset classes like gold that were mentioned that play a certain role that other asset classes don't? So yeah, these are the three I would say. Don't wait on the sidelines. Don't be surprised, and diversify.
Excellent. Thank you, Mark. Maurice, your advice.
Yes, you said 2025, but I will start with a general principle. There's no way to get rich quickly with any financial assets unless it's illegal or it's a scam. So be careful and be also aware of costs that are the worst enemy of as you said, the magic of compounding return, which is wealth management is all about that. Second, I would say for 2025, there is one risk that we're a bit scared of, which is inflation. And that's something that is, this risk is not priced in by any asset class currently, at least in developed markets. And as you said rightly, in 2022, it was the detonator behind the big catastrophe. So that's something to keep in mind. And also, in the same vein of interest rates potentially rising, the debt sustainability of some governments may be a question, and that's something that also questions the traditional diversification and what is a safe asset. It's not just something super liquid with a government on top. You have to look at it. And my country, France, was the outlook was downgraded by 2 agencies in the last 2 weeks. Something to look at. And the third thing is positive, because again, I believe that this economic revolution around the Indian Ocean, that's where I put it regionally, but it's also linked to the BRICS Plus. It's only the beginning of the story, and their valuations are not crazy. Diversification is mostly geographical now. Of course, asset classes, but also geographies. Yeah.
Thank you very much, Maurice. Maurice Gravier, Mark Chahwan, thank you very much for your time in Money Majlis today. You've been amazing in the discussion. This is the first time that we tried the format having 2 guests in the studio at the same time. And I think we had a very good discussion, sometimes a healthy debate. So thank you very much for your time.
Thank you. I really enjoyed it.
Thank you, Mr. Suvo Sarkar.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by Weo Bank. Fuel your ambitions with banking designed to power your success. Discover more at weo.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aqua Now, the premier crypto as a service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
So that's it for today's episode of Money Majlis, the last episode for 2024. I hope you enjoyed that format of 2 guests together in one episode. If you did, please share it with your friends and colleagues. And as we head into the new year, I want to wish you a restful holiday full of fun and festivities. I also want to thank you for your support of Money Majlis through the past 8 months since I started the podcast. Just seems yesterday, in May of 2024. Also, I'm proud to share with you that thanks to your support, Money Majlis was awarded the Best New Podcast for 2024 in the Podclub People's Choice Awards last week. Yes, guys, we are the Best New Podcast for 2024. I can't tell you how proud and grateful I am for this recognition, and this wouldn't have happened without your full support. I want to shout out my thanks to my research partner, Shekhar Krishnamurthy, my producer, Ginva Atiye, my studio, Podster, and my sponsors, MasterCard, Weo Bank, Network International, and Aqua Now. Thank you all so much. With that, I wish you a very happy New Year 2025. Stay well and do good. And I'll see you in the new year very soon.